Christmas show. You're driving around, maybe it's Christmas Eve. This is the Christmas Eve show, right?
Yeah, the Christmas Eve show. The Christmas special.
And then got an idea for you for a present. Give yourself the gift of high yields.
All right.
We'll do that in the first segment. Talk about that.
If she comes, she comes. If she don't, she don't.
Yep.
Ready? All right, here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hunt of Pacific Private Money, one of California's fastest growing mortgage investment firms. For those of you new to our show, imagine a few guys and gals sitting around a bar having drinks without the drinks talking business. With you, the audience listening in. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 tanning certificates given away during this show. Those certificates are not sponsored by the radio station, but by Tan Bella Tanning Salon, 2 locations in San Francisco and 1 in Marin. Today's trivia theme is just miscellaneous trivia, and this is our Christmas Eve show.
Absolutely. In fact, you mentioned, our show is like a few guys, gals sitting around in a bar having drinks without the drinks. It's just you and I today. So
far.
I should have brought a couple of brews. I still have some left over from the holiday party. Got some Lagunitas IPAs, nice and cold. I should have brought with me. But yes, it is the Christmas Eve show. So if you're listening in and you're in your car, hopefully you're not mad dashing it to buy some last minute gifts because, well, first of all, if you even find a parking space, good luck with those lines. But hey, if you're looking for some last minute gift ideas, why not consider giving yourself the gift of high yields?
Sounds good to me. Where do I sign up?
Well, for you listeners of this show, we've been doing the Best of Investing since August of 2010, so over 6 years. And for about half that time, back in 2013, my company, Pacific Private Money, were a regional marketplace lender, non-bank financing for real estate transactions, and we use private capital to fund those loans. And our investors, which number about over 300 right now, pretty much most of them living right here in the Bay Area, who have invested their funds with Pacific Private Money in either directly in mortgage secured notes or in our mortgage pool fund, which we launched in 2013. And for those investors that have been investing with us, they've been earning yields anywhere from the high 7s to as much as 10% on their money. So, if you're looking for a way to boost the income that you earn on your savings and your IRA accounts, because our investments are perfect for your self-directed IRA, you really owe it to yourself to investigate what we like to talk about, a term mortgage investing. And mortgage investing is essentially where you invest your monies and they are used to fund a real estate secured loan. This is where you're being the bank. And so the Pacific Money Fund, it's December, year end, and so for the year we're going to end up a little bit below 8%. Last year we were just a little bit above 8%, but due to competition, rates for the type of loans we do, some people prefer them as hard money or private money real estate loans, the rates have come down a little bit in California, and so our fund is probably going to end up the year about 7.75% or 7.8% after we do all the fine-tune all the accounting for the year. That's still a pretty darn good return. Now, short-term rates this month, that was the news. They've gone up, a whole 0.25%. So prime went from 3.25 to 3.5. How's that savings account looking right now? Has your local bank notified you of how much more they're paying you on your savings and money market accounts? Probably not.
Not too much. Close to 1%.
Yeah. Well, and looking ahead to 2017, I can't say that I got the best crystal ball in the world, but I'd be willing to wager that you're not going to see money market and savings account and CD rates going up really that much higher, because first of all, the Federal Reserve is really talking about maybe 2 or 3 increases in 2017, and that presumes a lot of things, because every year for the last 3 years, the year-end predictions for future mortgage rates have been, well, they're probably going to be 5% by the end of 2014, 5% by the end of 2015, 5% by the end of 2016. We haven't hit 5% or even close to 5% in many years. So will they be 5% at the end of 2017? Well, guess what? That's what most of them are predicting, but that doesn't mean it's going to happen. In fact, I've talked to a number of people who are in the money business, and some people are predicting that mortgage rates, which have gone up about 3/4 of a point in the last 45 days, conventional mortgage rates from 3.5 to about 4.25 on average. Some are predicting that those rates might actually go back down again in January and February after after the inauguration, and after we see exactly what types of programs the Trump administration is actually going to put forth. So there's no guarantee, just because a lot of people are saying and believing that rates are going to go up, savings rates, CD rates, mortgage rates. That doesn't make it necessarily so, because again, there's a lot of international variables that impact rates and which direction real estate's going. And we're going to talk a little bit more about that today, but just kind of coming back full circle on giving yourself the gift of a higher yield than you're probably earning right now. Now, of course, the stock market's doing great. It's up quite a bit in the last few months. But unless you're in the market, do you really want to, invest more in the market right now, or maybe you think that, once we hit 20,000, that there might be a little bit of profit taking there. So anyway, if you're looking for alternative places to park your money, and the nice thing about the Pacific Private Money Fund, which is again now paying just a little bit less than 8% on an annualized basis with monthly distributions. We are actually changing the investment lockup period. As of January 1st, we are going from a 24-month lockup to just a 12-month lockup. In fact, the 12-month lockup, that's the minimum lockup that you're required to have for these types of fund syndications. So 12-month lockup, so we're not looking for a long-term commitment from you. So if you invest for at least a 12-month period, your account, there is no fee, also called a load, no load going in or out, no fee going in or out. You invest $100,000, you get $100,000 back. If you take monthly distributions, or more than that, if you allow your distributions to compound, which is great for if you're in an IRA, if you invest through an IRA and you don't need those monthly distributions. So for more information on how you can earn high yields secured by Bay Area real estate mortgages, just like the bank, go to PacificPrivateMoney.com. That's PacificPrivateMoney.com for information on how to be an investor with us, or call us. Call us next week. We're open during the holidays. 415-883-2150.
Okay.
Yeah.
We're going to get more into that, because we want to find out how you're able to pay those kinds of rates
Absolutely.
in the next segment. All right. First commercial break, trivia question, is what video, the first to cost over $150,000, helped Michael Jackson's Thriller soar? That's the question. All right. We're going to do this. The first 3 callers with the correct answer will win a free tanning certificate at Tan Bella. So call 888-912-1190 to answer that question. What video, the first to cost over $150,000, helped Michael Jackson's Thriller soar? Don't touch that dial. The best investing is going to be right back.
get the thriller. That was an awesome album when it
Yeah.
came out. The first video that cost more than $150,000. I'm trying to think of what his early releases were because he had so many hits off that album. Because the album was Thriller, and there was the song called Thriller, which had that long video, which
Yeah.
cost yeah, right. That's right. Came up with a lot of good moves, that guy.
Yeah. I always like that moonwalk. Could never do it, but I like that.
That moonwalk's awesome.
All right. Segment down. Here we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. First commercial break, we asked this trivia question. What video, the first to cost over $150,000, helped Michael Jackson's Thriller soar?
There were so many hits off that album, in fact, that for the longest time, that was the most #1 singles from any album.
Yeah.
And I'm going to guess Beat It.
Correct.
Ah,
Very good.
I love that one.
Or Eat
That
It, if you're Weird Al
Weird Al
Yankovic.
Yankovic, the Eat It video parody of that was awesome. You know what I loved about that, the Beat It one, is the solo there by Slash from Guns N' Roses.
Oh, yeah, that's right. Okay, so Mark, before we get in, I want to make a quick mention here. Whether you're local or entertaining visitors, please check out the new Cityscape Viewing Lounge at the Hilton San Francisco Union Square for 360-degree views that are out of this world. This new San Francisco landmark serves up signature cocktails, premium wines by the glass, and locally crafted beers, as well as tempting appetizers, all of which complement the city's landmark vistas. It really does have 360-degree views. It's phenomenal.
Nice.
Okay, let's see. So, Mark, quick question for you. How can the Pacific Private Money Fund produce yields to be able to give out? Right now, it's close to 7.75%.
Yep.
Net to the client.
Yes, net to the client. So we're talking about giving yourself the gift of high yields this coming year, and why you should consider mortgage investing if you haven't already, or maybe you used to invest in notes in the past and have found it maybe more difficult to find individual notes to invest in. At Pacific Private Money, we work with individual note investors, and we have a mortgage pool fund that makes it easy for the passive or the inexperienced note investor to benefit from the success that we've had at Pacific Private Money in creating an organization that sees a tremendous amount of deal flow. And so the question that Edward posed is, how can our fund, the Pacific Private Money Fund, pay nearly 8% net to the investor on an annualized basis through our fund, when bank loans are at 4 and 5%? Well, the answer is we are not a bank, but we are a Plan B, or an alternative real estate financing source for a significant number of Northern California transactions where bank financing is not an option. And so what oftentimes happens is that, for example here, I've got some statistics in an article that I'm going to share with you later that, among other things, says that 25% of transactions, real estate transactions in the Bay Area today, are still cash.
Really?
So cash buyers are still out there, oftentimes getting the best deals. And as a seller, I can tell you, as someone who sells real estate, because I'm also an investor as well, if I have to choose between a cash proposal and a finance proposal, even if the cash proposal is less, I'm more likely to take that because I want that the surety of closing the transaction, rather than going through a 30 to 45 day, we hope everything goes perfect type of scenario. So cash is king, and what a lot of people are resorting to today in order to compete with cash buyers is they make an offer that has no financing contingency, even if they don't have all of the money to buy that real estate. If they have enough collateral, we can do a fast closing hard money loan up to 100% of the purchase price of that property. So people come to us when A, they want to compete with cash buyers, or B, they've got all their equity tied up in their existing home and they don't want to sell that first before buying their next property. So we can make them a loan that's secured by both the target property that they want to buy and their existing property. Other transactions are when they had bank financing lined up and there's a glitch in the process. Maybe something popped up on their credit or they did something they weren't supposed to, which impacted their credit. Now the bank's saying, we can't close, or we can't close for another 2 or 3 weeks. And maybe you're already into escrow for 30 days and the seller is saying, look, we're not going to give any more extensions. You either close by Friday or we're going to keep your deposit and move on. So we've saved a lot of deals in 2016 where there was significant deposits, as much as $100,000 at risk of being lost because their bank financing didn't come through. So those are the types of loans we do. And for the use of a loan from Pacific Private Money, a short-term, fast-closing, easy documentation process, we charge a higher rate than the banks do. That's the bottom line, is that we're fast, reliable financing with a tenth of the paperwork that you have to do with a bank. And oftentimes we can make a decision literally over the phone, tell you yes and green light that deal. The average note rate that we charge for our short-term, no prepayment penalty, fast closing loans is between 9 and 10%.
So even though that's higher, if I'm the borrower, if I don't plan to keep your loan too long, it's not costing me that 9 or 10% for like a whole year if there's no prepayment penalty.
That's right. You can pay it off in 6 days, 6 weeks, 6 months, just not 6 years. We like short-term financing. Most of the loans we write are for a 1-year period or less. They're also called bridge loans. You might have heard that term talked about in the lending and real estate industry. They'll say, oh, you just need to get a bridge loan. And that usually means something that's an easier to acquire, fast funding, but short-term in nature. And so probably the most expensive part of a loan from a company like ours, Pacific Private Money, is the points that you pay. And that's so if you're only using the money for, say, 30, 60, 90 days because you know you can get bank financing, you just need to close the transaction, you just need a fast cash source now. We do charge points, and that's how the brokerage makes its money. So a point is equal to 1%. So on a $1 million loan, if we charge 2 points for that loan, which is typical, that's $20,000. And so it does increase the cost of the real estate. So for some people, that's too high, and we do get sticker shock. Sometimes people go, that's just crazy, and they'll walk away from the deal rather than pay that high price for the money. But again, it's a decision, and there's been enough people who have thanked us profusely for giving them an option. And I mean, we're right up front about that. There's nothing hidden. Yeah. We tell you, right over the phone exactly what this is going to cost you and whether or not we think under your particular scenario, your situation, whether or not we can close. And so it's a very easy, friendly process and reliable, and we benefit from a fabulous deal flow from realtors and mortgage brokers throughout the Bay Area with whom we've created a relationship and a reputation for reliability and performance. And again, that's number one. So when you really, really, really want that property and you're out of options, Pacific Private Money is the call you should make next.
Okay, when we come back, we're going to ask you an email question that came in about why banks won't lend short term. So here's our next trivia question. What was the first Arnold Schwarzenegger movie to win 4 Academy Awards? Call 888-912-1190 to answer that question. And the first 3 callers?
And it wasn't Conan.
And it wasn't Conan. All right, stay with us. The Best of Investing will be right back. Last time I went over...
a minute.
And I got a minute and 40 seconds.
Okay, so it's beginning to do the.
Oh yeah.
I haven't done the timer yet, so the next one is 8:40.
Yes.
And then you got the email question, and I don't have.
And I do have one thing about banks. About that. I don't know if you read this article, but I thought it was very interesting.
Okay.
I'll bring it up.
Yeah.
So that's what I was thinking. thinking about, it's interesting. It's like, okay, so you do when everyone is competing out there for deals. I got to give quick. I got to do an all cash deal. But I'm thinking if rates or if things slow down, people could probably make a low. They don't have to compete as much. They can make a lower offer. But the thing is, that your advantage there is that Mr. Borrower can save money on potentially making an offer that's lower than asking if things are slowing down, but say, I'm coming in with all cash.
Yeah, absolutely.
So we can kind of talk a little bit about that.
Yeah, I wouldn't be so bold as to say that a real estate downturn or recession wouldn't impact our business. It absolutely will. But again, if we continue marketing the way we've been, we should see more than our fair share
about
of
the
inquiries.
Yeah. Yeah. I mean, you're still going to have the risks
Yeah.
of real estate going down.
Yeah.
But, okay. Ready?
Yep.
Then we'll get to email. Here we go. Well, welcome back to the Best of Investing. One more time. I'm Edward Brown, your host, along with Mark Hahn. What was the first Arnold Schwarzenegger movie to win 4 Academy Awards?
I didn't even know he was in a movie that won any Academy Awards.
Well, I don't know if it was for Best Actor. I don't think it was that. It could have been anything, right? Best costume or whatever. Terminator 2. Not even Terminator 1, but Terminator 2.
Terminator 2. It must have been, those technical awards
That's what
for
I'm
special
thinking.
effects and stuff. That's right. Wasn't that with the silvery guy?
Yes,
That melty schmelty
exactly.
guy?
Very good. Yeah, it pretended to be a cop.
Yeah.
Okay, so Mark, an email comes in that says, why won't banks lend short term?
Well, to be honest with you, I don't actually know why. I just know they don't. And so,
Well, I'm going to guess ahead of time that it's because they have to spend. They don't have prepayment penalties.
Right.
A lot of times they don't charge points. So if they have to do a loan that they know they're going to get paid back, if I remember hearing correctly from one of your brokers, there was a lady who was going to do this deal, fix and flip, and then when she posted it on Facebook, and the bank didn't realize it. Wait a minute, you mean you're just going to flip this?
right,
property?
she represented to the bank that she needed an investment property
Exactly.
loan,
Yeah.
and they were thinking maybe it was going to be a 5 or 7 year loan,
That's
and
right.
and they saw that she was going to flip it,
Yeah,
and
so
that wasn't
they-
revealed by the mortgage broker to the funding source. To the bank.
Exactly.
Yeah,
So
that's
so
right.
they denied it, and they say, well, why would they deny it? Well, if they're not charging a bunch of points, then they're doing a whole bunch of work for a loan that's going to last 2 or 3 months because she's going to flip the property.
Well, and actually, I do know the answer. It's being a little bit flippant there. Banks are looking to make loans that they can wrap up and sell on the secondary market,
Very good point.
and basically creating something like a bond, like a mutual fund of mortgages. So that's they make their money by doing that. And when
Derivatives and credit default swaps and all the fancy stuff.
all the stuff from that movie.
Yeah.
Or real life,
Yeah.
if you lived through it like we did.
Yeah.
So many of those loans so a bank makes a loan and they sell it on the secondary market. If it gets paid off within a certain period of time, the bank has to forfeit their fee on that. So that's so in any event, that's banks are generally not in the business of making short-term loans. They're really looking to create an investment security that they can sell, kind of like an annuity. They're selling, it's a contract between the lender and the borrower to make certain payments at a certain interest rate over a certain period of time, and that instrument becomes something that they can sell. And so, if they're unless they are a portfolio lender, which is what some regional banks are. So if you have a relationship with a regional bank, you may be able to go in there and make a deal with them where for fee income to the bank, maybe they'll charge you more points. Then you can have either a line of credit or a relationship where they don't mind if you pay back the loan. But your major mortgage lenders, they're looking for to make long-term loans that they can then sell to other banks. It's kind of funny because even banks like Wells Fargo are buying loans that are originated through mortgage brokers. So our local mortgage broker, Jeremy, that used to be on our show, He's the guy I go to every time I want a mortgage on one of my properties. And the one we did most recently was done by some bank that I can't even remember the name for. But literally just a few weeks, I think it was less than 30 days, I got a letter in the mail from Wells Fargo saying, we just bought your loan, send all future payments to us. And it's funny because I actually bank with Wells Fargo, so I didn't even think to walk into Wells Fargo, and even if I did, I might not have gotten that loan.
Exactly.
Well,
I know I've had investment property loans where they have a very substantial prepayment penalty.
That's typical on commercial loans, where they'll give you commercial loans. If you want the best commercial rate, you need to agree to some pretty onerous prepayment penalties. And usually they'll do a 10-year loan, and you can't prepay it until the last 90 days. And if you do, they have this formula for a prepayment penalty that is so onerous that very few people would ever do that.
Yeah, I don't know about 10-year loan, but I know definitely 5 to 7 years.
Yeah.
And usually it's the first 3 years are really nasty, but even after that, they have either the credit default swaps or the defeasance or all this other kind of stuff.
Right.
So I was going to ask you about an article that I had read, and it talked about how banks are required now to issue long-term debt that converts into equity upon bankruptcy. And this would be a bankruptcy of the bank. So the question, basically what they're trying to do is they don't want to bail out all the banks all the time. And so the theory is you have these large banks that in case they get into trouble, the lenders, who are bondholders, basically would just automatically convert into equity. So in theory you say, well, that sounds like a pretty good deal. But then here's the question. Won't that debt cost more due to the risk? Right? That means the banks would have to float bonds that are going to pay a higher interest rate. Because if I'm the potential bondholder and I know that if things get into trouble, I'm automatically going to get switched into an equity position, that may not be a good thing for me. So, I'm not going to do it at a low interest rate. I'm going to charge the bank basically a higher interest rate. And if that happens, then how will that affect the consumers and taxpayers if the banks have to issue higher interest debt? You see what I mean? It's kind of this vicious circle.
I'm getting a headache.
Yeah, but you see what I'm getting at, though. It's like Congress, I guess, is trying to say, well, let's protect everybody in case these banks, the too big to fail idea.
Yeah. Well, we were talking earlier about giving yourself the gift of high yields, and of course, so we're really talking real estate and mortgages and mortgage investing on this show today. But here's an article about the real estate market that I thought was interesting. It talks about the Case-Shiller Home Price Index, and this particular article starts out by saying, our long national nightmare is over. After 10 years, the Case-Shiller Home Price Index is just a smidge above its previous peak from July 2006. Now, before I go on, I will say this is the national. This is not the Bay Area, because as we know in the Bay Area, or for those who've listened to the show before, in the Bay Area, depending on what price tier you're at, you're either above the last peak or below the last peak. But anyway, here the article goes on to say that 10 years was the longest sustained dip in national home prices in decades, and obviously its effect on American citizens and the economy have both been deep and widespread. Also says the Case-Shiller Index uses nominal prices, so when you adjust for inflation, we're still below the peak. Again, this is the national average. Still, it's something of a mystery as to why prices have recovered as far as they have. They've substantially outpaced income growth since the market's bottom in 2012. Home prices aren't an asset class that can indefinitely grow wildly out of proportion to incomes. Of course, we know that. And they're too large a component of household spending and too big a part of the economy to keep growing at a rapid clip when other components of the economy aren't. So what's been the cause of this run-up where we've essentially matched on a national scale the housing peak from 2006? And it has, it has three ideas about this. One is,
which we're going to have to cut through a break.
I went long on that one.
Sorry
Okay,
about that.
all right,
That's
good.
okay. You'll get into that in just a minute. All right. So here's the next trivia question: is what martial arts specialist starred in Walker, Texas Ranger? Right? 888-912-1190. I knew Mark would know this one. All right. Don't touch that dial. The best of investing will be right back. Sorry about that.
That's all right. I totally stopped looking at you and the clock. I had 919 for that one, but
No.
was that
This
was
is
that the
919.
840? Oh,
Yeah.
okay. God, that's why I thought I still had a minute. So,
Don't forget where you left off.
yep.
Ready? Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn. What martial arts specialist starred in Walker's Texas Ranger?
Walker,
Texas
Texas
Ranger.
Ranger, and it's on the tip of my tongue. You'll have to.
Chuck Norris.
That's it.
That's it. I knew you'd know it.
I did know it. I used to
Okay.
watch that show, but I just couldn't remember his name. Dang it.
Go ahead.
So before the break, I was running a little bit long last segment, and I was talking about an article about how the Case-Shiller Index, which is one of the most widely followed indexes, home price indexes in the country, both nationally and regionally. We talk about it here. I personally track the San Francisco Bay Area Home Price Index. But this article was written about the National Home Price Index, and the National Index has now reached its peak from 2006. And the author says, essentially, there are three reasons why she believes that this has happened, and wonders whether or not, there might be a bubble here. And she doesn't predict a bubble, but she does say that it's that the run-up is largely due to the following three reasons. One is, of course, low interest rates. The second is the undersupply of housing. And the third is something interesting that I have not heard as an opinion before, and that is an overcorrection after the crash. And I thought that was really interesting. It says, after asset bubbles, markets often overcorrect in the other direction. The 2012 trough, basically the bottom of the real estate market, may have represented an underpricing, in which case it would make sense for prices to grow faster for a few years. So the article basically, in summary, says, are we due for another correction? And she opines here. If you think that the reason we have reached the 2006 peak is that it's a correction or an overcorrection from the original overreaction, then maybe prices, could potentially be in line for a correction. Although it here says,
how much of one?
well, of course, that's everyone's crystal ball, right?
Yeah.
If you think it's interest rates, then what happens will largely depend on where interest rates are headed. And of course, we know from history, the last several years, that we've been wrong every year predicting where interest rates were heading. And if you think it's mostly a story of rising demand pressing up against a limited supply, well, she says that's the sort of problem that markets generally fix. Although that's, again, that's nationwide. Maybe that's true. Definitely not in the Bay Area. I don't see that as fixing. So anyway, make a long story short, no one's crystal ball is highly accurate when it comes to predicting where real estate prices are heading, but nobody that I'm following is predicting for the Bay Area a significant dip in housing prices, if at all, in 2017. Now, I'm going to be a little bit more specific about that. We are seeing in some markets, the higher end of the market, the over X $1 million market, and again, the high-end market is different in every market. In Marin, it's homes over $10 million. San Francisco, the Peninsula, let's say maybe homes over $5 million. Something needs to be over $10 million, but the over $5 million housing market in Marin, San Francisco, and the Peninsula is seeing some softening, and there is downward pressure on prices. And we might see a year from now where the average or median price on homes in that market are actually less year over year. That wouldn't surprise me at all. The middle and the bottom end of the market, my guess is that we're going to continue to see price appreciation. Right right now, if you look at California sales for the last 12 months, you know, we sold 20,000 less units in 2016 at the $500,000 and below mark than we did in the prior year. So, and that's really just because the supply of homes at that price range has just gotten extremely tight. So, you know, again, my crystal ball is as good as anybody else's, but I think that real estate for 2017 looks to maintain its upward trend. Beyond that, 2018, you know, all bets are off. I mean, this cycle is running long, and so we are at the you know, at the tail end, I think, of the business cycle. A lot of it's going to depend also on what Trump does. What if Trump comes in and slashes tax rates, slashes the capital gains rate? Maybe I read an article in the Wall Street Journal that had an opinion that maybe he converts the 3 tiers down to 2 tiers. So you know, that could set up a whole new boom of growth. Of course, it could accelerate inflation too, which again, if you're a real estate investor, is not necessarily a bad thing. So it's really, you know, we really just there's just we're in a really interesting time right now. I mean, this is going to be fun doing this show in 2017 because we're going to start seeing a lot of interesting behaviors and patterns emerging from Washington, and a lot of times what Washington does doesn't impact us here in the California Bay Area much, but the housing market could certainly be impacted by the direction that rates head, the direction that tax rates head, and something else that's kind of rung up its ugly head again is mortgage interest deduction. That could also come back on the block, and they're talking about even further limiting that for, of course, the wealthy, you know, people with over a certain amount of interest.
How many people have loans that are in excess of $1 million?
Well, that's just it. So maybe that number gets reduced. I don't know. There's a lot of different ways that you know, they can tackle that. So it's you know, it's anybody's guess. So anyway, it's going to be a very interesting year. So a lot of the investors that we have at Pacific Private Money, you know, because of what we're talking about, you know, which direction is the market going, or you know, is there going to be a correction? Are we in a bubble? You know, all of those things, all of the nervous reports that they read. We get calls all the time asking me, well, how is that going to impact mortgage investing? How is that going to impact what your fund can produce? And my answer oftentimes kind of surprises them. And the answer is this, is that the need for short-term capital, the need for a hard money loan, a quick, assured source of financing, that demand has been relatively stable over the last 10 years. Going into the market correction, even after the correction, I mean, we were making loans in 2008, 2009, 2010, all the while the market is still trending down. Prices are still going down. We do a tremendous amount of marketing at Pacific Private Money, and we get actually more than our fair share of leads as a result of our awareness in the market space, the marketing we do to realtors and mortgage brokers. So, you know, yes, demand for short-term money will change, and we're prepared for that change. We're opening up other markets. We're looking at doing construction lending. We're getting even more aggressive on the consumer lending front, coming up with subprime programs. We're investigating new sources of capital in 2017. We're members of a bunch of organizations, family office and other groups where there are a lot of sources of capital that you know, you, the listener, would never have heard of unless you're in the capital raising arena. And there's just a tremendous amount of capital in circulation right now that's looking for yield. And so we're looking for sources that will help us grow our business. And so I tell my fund investors that, you know, our phone rings and rings a lot, and we're seeing a lot of deal flow. And I don't see that deal flow being impacted that dramatically in the coming months and even in the coming years, just because of the type of marketing that we do and the type of capital needs that we serve. So again, for more information and give me a call. I love talking about this type of stuff. I'm always available by phone, 415-883-2150. My name is Mark Hanf. My company is Pacific Private Money, located right here in the Bay Area.
And don't touch that dial. The Best in Investing will be right back with some closing comments. I wonder, when you say the word subprime, I wonder if that makes people kind of, because they don't really understand.
Okay.
They hear the term.
Let me talk a little bit about that
Yeah.
when we get back. Stop. In the last segment, 510?
Yep.
How much do you like for your outro?
Oh,
About 30 seconds? 45 seconds?
45 seconds. All right, ready?
Yes.
And do you have any specific deal of the week?
I don't. Probably if I thought about it for a few minutes.
We did that 1 second. Can you just give an example?
I do. I've got one that's
Okay.
close. I've given it before, but it was weeks ago.
All right, here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hanf, president of Pacific Private Money. Now, Mark, before we left, you used the word subprime, and it probably makes people kind of wince a little bit. Did you get that?
That's true, because the word subprime now has a negative connotation based on misinformation that thanks largely to the media and probably the government themselves, where they blamed subprime lending and subprime loans for the cause of the bubble and the cause of the markets crashing, et cetera. And that's not really true, and we don't have enough time to get into a detailed discussion of that, but I will say that the subprime simply means you're not a prime borrower, you can't get a conventional type of rate, and the subprime lending industry did, for the most part, disappear after 2008. The number of loans being originated today that would be classified as subprime is a literal fraction of the amount of loans that were being originated under that definition in, say, 2005 and 6. And so there are companies like ours, like Pacific Private Money, who are kind of dipping their toe back into that industry where we can provide a long-term loan, a 30-year fixed loan, at rates that are subprime. And in today's market, that is somewhere from 6.99 to 7.99 on the note rate. If a conventional mortgage is, let's say, somewhere in the fours today, and there is a significant portion of the population for whom that is the type of financing that they can realistically get based on their particular, based on their FICO score, their ability or inability to document their income. And there's all kinds of things. We've talked about on the show for years. Bank loans, conventional loans are just so much harder to get today, thanks to Dodd-Frank. And so you've got a huge swath of America that has been kind of left without a product. And so when I say that at Pacific Private Money we're looking to dip our toe into that, what I would call subprime, what I'm really saying is we're looking to create some options for people who today almost have no options.
Okay, well, give us a deal of the week.
So deal of the week. So we are doing a deal for a couple. One of that couple lives in San Francisco and owns their home. The other part of that couple lives in Southern California and owns their home. And so they have decided to move in together. And they want to sell their homes. And when they first came to us, they had anticipated that it might take some time to sell both of them. And so they were looking for some bridge loan options to buy this new home in Orange. And so we gave them a number of options, and they said, great, well, we're going to go put our homes on the market and see how well we do, and then we'll come back if we need your help. Well, they came back because, as it turns out, neither of them have been able to sell their homes yet. And I actually don't have the detail on why neither of them could sell their homes. Neither of them were sophisticated real estate investors, so I guess they didn't market their home at the appropriate price. But as it turns out, they need a bridge loan for 100% of the purchase price.
Because they found the house they like.
They found the house they like. They need to close on it. They were able to get a little bit of an extension, but that extension actually disappears by the end of this year. So next week we are closing on I think it's $1.1 million approximately is the purchase price, and that's the loan we're making them. And we're collateralizing it by putting a deed of trust on the target property and the 2 other properties.
So
The other three pieces of collateral for one loan. The combined loan to value on this is about 60% total. So we like that. We feel it's a very well secured loan. Both of these guys have incomes, and so that's our deal of the week.
Very good.
For more information, give us a call at Pacific Private Money. Of course, go to our website first, pacificprivatemoney.com. Learn about our company, see our bios and our information there, or give us a call, 415-883-2150.
Very good. I want to thank again my co-host Mark Hanf of Pacific Private Money for joining me yet again. Here's our thoughts of the day. Newt Rockne said, "One man practicing sportsmanship is far better than 50 preaching it." I thought that was pretty good. And Emil Zatopek, I don't know who that is, said, "An athlete cannot run with money in his pockets. He must run with hope in his heart and dreams in his head." And with that, we're going to sign off on our Christmas show here. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. Und that's a wrap.
Yeah.
Whew. Yeah, I did back-to-back sports shows too.
Oh,
so
my
it was,
goodness. So, yeah, no wonder you were yawning.
Yeah.